Revenue growth. The revenue growth indicates on how much the revenue has changed. In our example here, the revenue has grown to 110. In the period before it was 100. So increased by 10% from 100. 10%, good or bad? Well, revenue is the value of all sold products and services. So we did sell more at a higher value. If revenue has grown, of course, we have more profit potential, but that depends very much on the cost we have in the company also. But secondly, revenue growth has a big impact on market share. Let's assume the market grew more than 10% and we grew 10%. That means we grew less than the market. That means we lost relative market share to our competition, which is not so good. But if it was the case that the general market grew less than 10%, then we grew more, and so we gained market share. And market share is important. In this case, it's even more important to look at the units, at the number of units we sell and produce, and not so much on the price, the number of units, because size matters very much. Three effects on costs. First effect, fixed cost degression. Fixed costs are the costs we have because we have capacity in the company for machines, for personnel, for research and development, for administration. And the more we produce, the less fixed costs per unit we have. So we have less costs per unit. Secondly, higher production efficiency. The more we produce, the more volume we produce, the more potential we have for automation and standardization, and that is positive on costs. So also, the more we produce, less costs. And thirdly, we can simply buy cheaper at our suppliers. So we save costs here again. So size matters. It has a big impact on costs, and that is why our relative market share in the market is so important. Revenue growth.